Mastering Your Money, a guide to personal financial planning. In a world where financial stability and independence are crucial, taking control of your personal finances is essential. Mastering Your Money, a comprehensive guide to help you navigate the complex landscape of personal financial planning, irrespective of your current financial situation. This book empowers readers with the knowledge and tools they need to make informed decisions, set achievable goals, and secure their financial future. Chapter 1. Understanding Your Financial Landscape. 1.1. Importance of Financial Literacy. Financial literacy is essential in today's world, as it empowers individuals to make informed and responsible financial decisions. Here are some practical ways in which financial literacy can be important. 1. Budgeting. Understanding financial concepts helps individuals create and stick to a budget. By knowing how to manage income and expenses effectively, individuals can prioritize saving and avoid unnecessary debt. 2. Saving and investing. Financial literacy enables individuals to make smart saving and investing decisions. With knowledge about different savings accounts, investment options, and risk management strategies, individuals can grow their wealth and achieve their financial goals. 3. Debt management. Being financially literate helps individuals understand the implications of taking on debt and how to manage it responsibly. Knowledge about interest rates, credit scores, and debt repayment strategies can prevent individuals from falling into a debt cycle and maintain a healthy financial status. 4. Consumer awareness. Financial literacy allows individuals to become informed consumers. Understanding concepts like interest rates, terms and conditions, and fees associated with financial products helps individuals make better choices and avoid scams or predatory practices. 5. Retirement planning. Financial literacy plays a vital role in planning for retirement. Individuals with financial knowledge can gauge their retirement needs, explore investment options, and set realistic goals to secure their future. 6. Entrepreneurship. Having financial literacy is crucial for aspiring entrepreneurs. It helps them develop business plans, understand financial statements, manage cash flow, and make strategic financial decisions that can lead to a successful venture. 7. Insurance and risk management. Being financially literate helps individuals navigate the complex world of insurance. Understanding policies, coverage, and deductibles enables individuals to make informed decisions to protect themselves and their assets from potential risks. 8. Financial independence. Financial literacy empowers individuals to achieve financial independence. By gaining knowledge about financial concepts, individuals can take control of their money, make sound financial decisions, and reduce reliance on others. In conclusion, financial literacy is important as it equips individuals with the knowledge and skills needed to navigate the complex financial landscape. By being financially literate, individuals can improve their financial well-being, achieve their goals, and lead a more secure and stable life. 1.2. Assessing your current financial situation. Assessing your current financial situation. A comprehensive analysis. Introduction. Managing personal finances is a vital aspect of achieving stability and success in life. An essential first step towards effective financial management is assessing your current financial situation. By undertaking a comprehensive analysis, you can gain valuable insights into your income, expenses, savings, investments, debts, and financial goals. This article aims to guide you through the process of assessing your financial situation, offering practical advice and strategies to improve your financial well-being. Income assessment. Start by evaluating your sources of income. Consider your primary job or business income, as well as any additional income streams, such as rental properties or freelance work. Take note of the stability and consistency of each income source, as well as the potential for growth or diversification. Expense evaluation. Next, scrutinize your expenses. Categorize them into essential and discretionary expenditures. Essential expenses include housing, utilities, groceries, transportation, and healthcare. Discretionary expenses include leisure activities, dining out, travel, and entertainment. Analyze each category to identify potential areas for cost-cutting or optimization. It is essential to track your expenses diligently and make conscious decisions to align your spending with your financial goals. Savings and investments. Evaluate the state of your savings and investments. Review your emergency fund and assess if it can cover at least 3 to 6 months of living expenses. Determine if your current savings rate aligns with your long-term financial objectives. Additionally, analyze your investments, including retirement accounts, stocks, bonds, mutual funds, and real estate. Assess their performance, diversification, and risk exposure. If necessary, consider adjusting your investment strategy to maximize potential returns and minimize risk. Debt assessment. Assess your debt obligations comprehensively. Identify all outstanding loans, including mortgages, credit card debt, student loans, and personal loans. Review the interest rates, repayment terms, and outstanding balances for each debt. Consider creating a debt repayment plan to prioritize high-interest debts and accelerate your journey towards financial freedom. Explore opportunities to refinance or consolidate your debts to lower interest rates and save money over time. Net worth calculation. Calculate net worth by subtracting your total liabilities debts from your total assets. Your assets may include cash, investments, real estate, and valuables. This exercise gives you a holistic view of your financial position and helps you understand your current wealth accumulation progress. Regularly updating and tracking your net worth can be motivating and provide a clear sense of direction for your financial endeavors. Financial goals. Define and review your financial goals. Whether it is saving for retirement, buying a house, starting a business, or paying for your child's education, clearly articulating your goals is crucial. Assess the feasibility and timeline for achieving each goal. Break them down into smaller, actionable steps and establish a realistic plan to attain them. Regularly monitor your progress and make adjustments as necessary to stay on track. Risk management. Evaluate your risk management strategies. Assess the sufficiency and coverage of your insurance policies, such as health insurance, life insurance, disability insurance, and home insurance. Make sure your policies align with your current circumstances and provide adequate protection for you and your loved ones. Consider consulting with a financial advisor or insurance professional to ensure you have the right level of coverage based on your unique situation. Monitoring and review. Lastly, establish a routine for monitoring and reviewing your financial situation. Regularly track your income, expenses, savings, investments, and debt repayment progress. Revisit your goals periodically and assess if any adjustments or refinements are needed. Staying proactive in managing your finances will help you make informed decisions, seize opportunities, and stay on target for long-term financial success. Conclusion. Assessing your current financial situation is an invaluable exercise that allows you to gain a comprehensive understanding of your financial health, strengths, and areas for improvement. By taking the time to evaluate your income, expenses, savings, investments, debts, and financial goals, you empower yourself to make informed decisions, optimize your resources, and work towards achieving financial stability and prosperity. Regularly monitoring and reviewing your finances ensures that you stay on track and adapt to changes in your circumstances. With a clear assessment and a well-defined plan, you can confidently navigate your financial journey and build a strong foundation for a secure future. 1.3. Identifying financial goals and aspiration. Identifying your financial goals and aspiration is an important step towards building a solid financial plan. Here are some steps to help you in this process. 1. Reflect on your values and priorities. Think about what matters most to you in life. This could be things like home ownership, starting a business, saving for retirement, traveling, or supporting your family. Understanding your values will help you align your financial goals with what truly matters to you. 2. Set SMART goals. SMART stands for specific, measurable, achievable, relevant, and time-bound. When setting financial goals, make sure they are specific and well-defined. For example, instead of saying "I want to save more money," specify a target amount and a time frame, such as "I want to save $10,000 for a down payment on a house within the next 2 years." 3. Prioritize your goals. Once you have identified your financial goals, prioritize them based on importance and urgency. Some goals may require immediate attention, while others can be long-term objectives. This will help you allocate your resources effectively. 4. Consider short-term and long-term goals. Short-term goals are typically those achievable within a year, like paying off credit card debt or building an emergency fund. Long-term goals may involve retirement planning, saving for your child's education, or purchasing a property. Balancing both short-term and long-term goals is essential for comprehensive financial planning. 5. Assess your current financial situation. Take a close look at your income, expenses, debts, and investments. Understanding your current financial standing will help you determine the gap between your current situation and your desired financial goals. 6. Seek professional guidance if you find it challenging to identify or prioritize your financial goals. Consider consulting with a financial advisor. They can provide expert advice tailored to your specific circumstances and help you create a roadmap for achieving your goals. Remember, regularly reviewing and adjusting your financial goals is crucial as your circumstances and priorities may change over time. Stay focused, remain committed, and take proactive steps towards turning your aspiration into reality. Mastering Your Money, a guide to personal financial planning. Chapter 2. Budgeting and Saving Strategies. To point 1, creating a realistic budget. Sure, creating a realistic budget is an important step in managing your finances effectively. Here's a general guide to help you get started. 1. Determine your income. Calculate your total monthly income, including salaries, freelance work, rental income, or any other sources. 2. List your expenses. Make a comprehensive list of all your regular expenses, such as rent, a mortgage, utilities, groceries, transportation, insurance, debt payments, and other necessities. Don't forget to include occasional or irregular expenses like medical bills or vehicle maintenance. 3. Categorize your expenses. Group your expenses into categories, such as housing, transportation, food, entertainment, and savings. This will help you analyze your spending patterns. 4. Differentiate between needs and wants. Differentiate between essential needs and discretionary wants. Focus on covering your needs first, and allocate funds for wants accordingly. 5. Set savings goals. Determine how much you want to save each month. Aim to save at least 20% of your income, although the more you can save, the better. 6. Track your spending. Monitor your spending regularly to ensure you're staying within your budget. Many personal finance apps and tools are available to help you track your expenses effortlessly. 7. Adjust and optimize. If you find that your expenses exceed your income, review your budget and look for areas where you can cut back. You might need to prioritize and reduce spending in certain areas to achieve a balanced budget. Remember, creating a budget is a dynamic process, and you may need to adjust it as your circumstances change. Stay disciplined and committed, and you'll be on your way to achieving your financial goals. To point 2. Effective money management techniques. Effective money management is crucial for financial stability and achieving your financial goals. Here are some key techniques to help you manage your money effectively. 1. Create a budget. Start by creating a realistic budget that outlines your income and expenses. Track your spending and identify areas where you can cut back or save money. 2. Set financial goals. Define short-term and long-term financial goals, such as saving for emergencies, buying a home, or retiring comfortably. Having clear goals helps you stay motivated and focused on your financial priorities. 3. Track your expenses. Keep a record of all your expenses to understand where your money is going. Use smartphone apps or spreadsheets to track your expenses easily. 4. Prioritize saving. Make saving a priority by automating regular contributions to your savings accounts. Aim to save at least 20% of your income, if possible. Start an emergency fund for unexpected expenses. 5. Minimize debt. Manage your debt by making timely payments and avoiding unnecessary debt. Prioritize paying off high-interest debt first, such as credit card balances. Consider consolidating or refinancing debt to potentially lower interest rates. 6. Cut unnecessary expenses. Review your budget regularly and identify expenses that can be reduced or eliminated. Cut back on non-essential items like dining out, subscription services, or impulse purchases. 7. Seek financial education. Educate yourself about personal finance and investing. Understand the basics of budgeting, saving, and investing to make informed financial decisions. 8. Review and adjust your plan. Regularly review and reassess your financial plan. Adjust your budget, goals, and investment strategies as needed to accommodate changes in your income or expenses. 9. Avoid lifestyle inflation. As your income increases, resist the temptation to increase your spending proportionately. Instead, maintain or increase your saving and investment contributions. 10. Seek professional advice if needed. If you feel overwhelmed or need personalized guidance, consider consulting a financial advisor who can provide expert advice tailored to your specific situation. By applying these money management techniques consistently, you'll be better equipped to make wise financial decisions, save for the future, and achieve your financial aspiration. To point 3, building an emergency fund. Building an emergency fund is a smart financial decision. Here are some steps you can take. 1. Set a goal. Determine how much you want to save for your emergency fund. It's generally recommended to have 3 to 6 months' worth of living expenses saved up. 2. Create a budget. Review your income and expenses to see where you can cut back. Allocate a portion of your income specifically for your emergency fund. 3. Start small. Begin by setting aside a small amount each month. Even if it's just $10 or $20, getting into the habit of saving regularly is the key. 4. Automate your savings. Consider setting up an automatic transfer from your checking account to a savings account. This way, you won't forget to save, and the money will be set aside before you have a chance to spend it. 5. Reduce unnecessary expenses. Look for ways to trim your budget. Assess your spending habits and identify areas where you can make cuts. This could include eating out less or finding more affordable alternatives. 6. Increase your income. Explore opportunities to increase your income, such as taking on a part-time job or freelancing. The extra money can go directly into your emergency fund. 7. Avoid dipping into the fund. Remember, your emergency fund is meant for unexpected expenses or financial crises. Try to resist the temptation of using it for non-emergency situations. 8. Celebrate milestones. As you reach certain savings milestones, it's important to celebrate your progress. Rewarding yourself can help motivate you to keep building your emergency fund. Remember, building an emergency fund takes time and discipline. Stay committed to your savings goals and make it a priority to protect yourself from unexpected financial setbacks. To point 4, the power of compounding, saving for the future. The power of compounding is a fundamental concept in financial planning and saving for the future. It refers to the ability of an investment to generate earnings, which are then reinvested to generate further earnings. Over time, the compounding effect can significantly increase the value of your savings or investments. When you save for the future, the earlier you start, the more time you have to take advantage of compounding. Here are a few key points to consider. 1. Start early. The earlier you begin saving, the more time your investments have to grow. Even small amounts can make a significant difference over time. 2. Consistency is key. Regularly setting aside a portion of your income for savings is important for harnessing the power of compounding. Make it a habit and stick to it. 3. Reinvest your earnings. When your investments generate returns, reinvest those earnings instead of cashing them out. By reinvesting, your earnings can generate additional earnings, compounding your returns. 4. Choose the right investment vehicles. Different investment options offer various rates of return and compounding benefits. Research and understand the options available to you, such as stocks, bonds, mutual funds, or even retirement accounts like IRA letters or 401ks. 5. Patience and long-term perspective. The true power of compounding unfolds over extended periods. Be patient and maintain a long-term perspective to maximize the benefits. Remember, compounding is a gradual process, so it's important to have realistic expectations. It won't result in overnight wealth, but over time, it can help you build a strong financial foundation for your future. Mastering Your Money, a guide to personal financial planning. Chapter 3, Debt Management. 3.1. Types of debt and their implications. Debt refers to money borrowed from a lender, which needs to be repaid according to agreed-upon terms. There are various types of debt, each with its own implications. Here are some common types of debt and their implications. 1. Credit card debt. This type of debt occurs when you use your credit card to make purchases and carry a balance from month to month. Credit card debt often comes with high interest rates, which can accumulate quickly if not paid off in full. It can lead to financial stress, impact your credit score if not managed properly, and restrict your ability to access more credit. 2. Student loans. These loans are taken out to finance education expenses. Student loans typically have lower interest rates compared to some other forms of debt. However, they can still be substantial and may take years or even decades to pay off. Failure to repay student loans can negatively impact credit scores, restrict future borrowing opportunities, and potentially result in legal consequences. 3. Mortgage loans. A mortgage loan is used to purchase a home or property. This type of debt is usually long-term and secured by the property itself. The implications of mortgage loans can vary depending on factors such as interest rates, loan terms, and housing market conditions. Defaulting on a mortgage loan can lead to foreclosure, which entails losing the property. 4. Personal loans. Personal loans are typically unsecured debts that can be used for various purposes, such as consolidating debts or financing major expenses. The interest rates and repayment terms can vary based on factors such as creditworthiness and the lender's policies. Failure to repay personal loans can damage credit scores and may result in legal actions by creditors. 5. Auto loans. Auto loans are taken out to finance the purchase of a vehicle. They can be secured or unsecured, depending on the lender's requirements. Defaulting on an auto loan can result in repossession of the vehicle and negatively impact credit scores. It's important to manage debt responsibly by making timely payments, understanding loan terms, and borrowing within your means. High levels of debt and missed payments can lead to financial instability and affect your overall financial well-being. Prioritize paying off high-interest debts first, and consider seeking professional advice if you are struggling with debt management. 3.2. Strategies for reducing and managing debt. Sure, here are some strategies for reducing and managing debt. 1. Create a budget. Start by evaluating your income and expenses to get a clear understanding of your financial situation. Identify areas where you can cut back on expenses and allocate more funds toward paying off your debt. 2. Prioritize payments. Make a list of your debts, including the outstanding balances and interest rates for each. Focus on paying off high-interest debts first while making minimum payments on the others. This will save you money in interest payments over time. 3. Snowball or avalanche method. There are two popular approaches to paying off debt. The snowball method involves paying off your smallest debts first and then moving on to the larger ones. The avalanche method involves prioritizing debts with the highest interest rates. Choose the method that works best for you. 4. Negotiate with creditors. If you're struggling to make payments, consider reaching out to your creditors to negotiate new payment terms. They may be willing to lower interest rates, reduce monthly payments, or provide alternative repayment options. 5. Avoid taking on new debt while paying off existing debt. It's important to avoid accumulating new debt. This means refraining from using credit cards unnecessarily and spending within your means. Stick to cash or debit cards for your purchases. 6. Increase income. Consider finding ways to increase your income to accelerate debt repayment. This could involve taking on a second job, freelancing, or finding other sources of additional income. 7. Seek professional help. If you're struggling to manage your debt on your own, consider consulting with a reputable credit counseling agency. They can provide guidance, develop a debt management plan, negotiate with creditors on your behalf, and offer financial education. Remember, managing debt takes patience and persistence. Stay committed to your repayment plan and make consistent payments, and with time, you'll be able to reduce and eliminate your debt. 3.3. Credit scores and their significance. Credit scores are numerical representations that reflect an individual's creditworthiness. They play a crucial role in financial transactions, as they help lenders assess the level of risk associated with granting credit to someone. Higher credit scores indicate a lower risk of defaulting on loans, while lower scores suggest a higher risk. The significance of credit scores lies in their impact on various aspects of personal finance. For example, when applying for a loan or credit card, lenders typically examine your credit score to determine whether to approve your application and the terms, such as interest rates, they will offer you. A good credit score can lead to more favorable loan terms and lower interest rates, potentially saving you money in the long run. Credit scores also influence other financial decisions, such as renting an apartment or securing insurance. Landlords and insurance companies often consider credit scores as an indicator of financial responsibility and reliability. A higher credit score may increase the likelihood of being approved for an apartment or obtaining more affordable insurance premiums. Furthermore, credit scores may affect employment opportunities or the ability to secure certain professional licenses. Certain employers, especially those in the financial sector, may check credit reports as part of their screening process. While credit history alone may not be the sole factor determining employment, a poor credit score could raise concerns about an individual's financial stability and trustworthiness. Maintaining a good credit score requires responsible financial habits, such as making timely payments on loans and credit cards, keeping credit utilization low, and minimizing outstanding debt. Regularly reviewing your credit report for errors and addressing any inaccuracies is also important for maintaining an accurate credit profile. In summary, credit scores have a significant impact on various aspects of personal finance, from loan approvals and interest rates to rental applications and employment opportunities. It is essential to understand the significance of credit scores and work towards maintaining a positive credit history. 3.4. Responsible borrowing and avoiding common pitfalls. Responsible borrowing is important to maintain financial well-being and avoid falling into common pitfalls. Here are some tips to help you borrow responsibly. 1. Assess your needs. Before taking out a loan or using credit, evaluate if it's truly necessary. Borrowing should be done for essential expenses or investments that will bring long-term benefits. 2. Create a budget. Have a clear understanding of your income, expenses, and financial goals. This will help you determine how much you can comfortably borrow and afford to repay without overburdening yourself. 3. Compare options. Explore different lenders or credit providers to find the best terms, interest rates, and repayment plans. Research and compare before making a decision to ensure you're getting the most favorable terms for your specific situation. 4. Read the fine print. Carefully review the terms and conditions of any loan or credit agreement before signing. Pay attention to interest rates, fees, penalties, and repayment schedules. Understand all the details and ask questions if anything is unclear. 5. Borrow only what you can repay. Never borrow more than you can realistically afford to repay. Consider your income, existing debt obligations, and monthly expenses to determine a comfortable repayment amount. Avoid overextending yourself as it may lead to financial stress. 6. Keep track of your debts. Maintain a record of all your loans, credit card balances, and repayment schedules. Stay on top of due dates and avoid missing payments, as it can negatively impact your credit score and result in additional fees. 7. Avoid reliance on credit cards. While credit cards can be convenient, excessive use can lead to high interest debt and financial strain. Limit your credit card usage to manageable amounts and pay the balance in full each month to avoid accumulating interest charges. 8. Communicate with lenders. If you face financial difficulties or anticipate trouble repaying a loan, contact your lender immediately. Many lenders have options to modify repayment terms or offer assistance programs to help borrowers in challenging situations. Remember, responsible borrowing involves making informed decisions, using credit wisely, and staying proactive in managing your financial obligations. By following these tips, you can avoid common borrowing pitfalls and maintain a healthy financial future. Mastering Your Money, a guide to personal financial planning. Chapter 4, Investing for Wealth Creation. 4.1. Introduction to various investment options: stocks, bonds, real estate, etc. Sure, I can provide a brief introduction to various investment options. Here are 3 commonly known investment options. 1. Stocks. Stocks represent ownership in publicly traded companies. When you buy shares of stock, you become a partial owner of the company. Stock prices can fluctuate based on market conditions, company performance, and investor sentiment. Stocks have the potential for higher returns but also come with higher risk. 2. Bonds. Bonds are fixed income securities issued by governments, municipalities, and corporations to raise capital. When you invest in bonds, you are essentially lending money to the issuer, in exchange for periodic interest payments and the return of your principal amount at maturity. Bonds are generally considered less risky than stocks, but offer lower potential returns. 3. Real estate. Real estate investing involves purchasing properties for the purpose of generating income or appreciation. It can include residential, commercial, or industrial properties. Real estate investments can provide rental income and potential value appreciation over time. However, they may require significant initial capital, entail property management responsibilities, and be subject to market fluctuations. It's important to remember that each investment option comes with its own risks, rewards, and considerations. It is advisable to research further, consult with a financial advisor, and understand your individual investment goals before making any investment decisions. 4.2. Risk Tolerance Assessment. Assessing your risk tolerance is an important step in determining the types of investments that align with your financial goals and comfort level. Here are a few key factors to consider when assessing your risk tolerance. 1. Time horizon. Consider the length of time you plan to invest your money. Longer time horizons generally allow for greater risk-taking due to the potential to ride out short-term market fluctuations. 2. Financial goals. Evaluate your investment objectives. Are you investing for short-term goals, such as a down payment on a house, or for long-term goals, such as retirement? Understanding your goals can help determine the level of risk you are willing to take. 3. Investment knowledge. Assess your knowledge and understanding of different investment options. Riskier investments may require more knowledge and expertise to navigate effectively. 4. Risk capacity. Evaluate your financial circumstances, including income, expenses, and overall financial stability. Assessing your financial capacity to absorb potential losses can help determine your risk tolerance. 5. Emotional resilience. Consider how comfortable you are with fluctuations in investment values and the potential for losses. Some investors may be more emotionally resilient and able to tolerate higher levels of risk, while others may prefer more stability. It's important to strike a balance between risk and reward that aligns with your individual circumstances and comfort level. Remember, risk tolerance can change over time, so it's crucial to regularly reassess and adjust your investment strategy accordingly. Consider consulting with a financial advisor for a more comprehensive risk assessment tailored to your specific situation. 4.3. Long-term versus short-term investment strategies. Long-term and short-term investment strategies are two approaches to investing that differ in their time horizon and objectives. Let's explore the differences between them. Long-term investment strategies involve holding investments for an extended period, typically around 5 years or more. The purpose of long-term investing is to build wealth gradually over time. Investors who employ this strategy focus on fundamental analysis, considering factors such as company performance, market trends, and economic conditions. They often invest in assets such as stocks, bonds, real estate, and mutual funds. One primary benefit of long-term investing is the potential for compounding returns. By allowing investments to grow over a longer period, investors can take advantage of market fluctuations and benefit from overall market growth. Long-term investors can also weather short-term market volatility, as they are less concerned with day-to-day price movements. On the other hand, short-term investment strategies involve buying and selling assets within a shorter time frame, usually less than a year. Common short-term investment approaches include day trading, swing trading, and market timing. Short-term traders rely on technical analysis, patterns, and short-term market trends to make quick profits. Short-term investing can provide opportunities for active traders to capitalize on short-lived market inefficiencies and take advantage of price fluctuations. However, it also carries higher risks due to market volatility and unpredictability. Successful short-term trading requires careful decision-making, timing, and thorough knowledge of the market. In summary, long-term investment strategies prioritize gradual wealth building over an extended period, aiming to take advantage of compounding returns and market growth. Short-term investment strategies, on the other hand, involve more frequent buying and selling of assets within a shorter time period, seeking immediate profits from short-term market fluctuations. The choice between the two depends on individual goals, risk tolerance, investment expertise, and time commitments. It's often recommended to have a diversified investment portfolio that balances both long-term and short-term strategies to mitigate risks and maximize returns. 4.4. Diversification and asset allocation. Diversification and asset allocation are investment strategies used to manage risk and optimize returns in a portfolio. Diversification involves spreading investments across different asset classes such as stocks, bonds, real estate, etc., industries, regions, and even currencies. By diversifying, you reduce the risk of having all your investments concentrated in a single asset or sector. This way, if one investment performs poorly, Others in the portfolio offset those losses and provide more stable returns. Asset allocation, on the other hand, refers to the process of assigning a specific percentage of your investment portfolio to different asset classes based on your financial goals, risk tolerance, and time horizon. The goal is to create a balanced portfolio that aligns with your objectives. The key benefits of diversification and asset allocation include: 1. Risk reduction. By spreading investments across various assets, you can minimize the impact of a single investment's poor performance on your overall portfolio. 2. Enhanced returns. Diversification and asset allocation can potentially optimize returns by capitalizing on different assets' growth potential over time and reducing vulnerability to market fluctuations. 3. Preservation of capital. By diversifying, you can reduce the risk of capital loss if one asset or sector experiences a downturn. 4. Increased opportunity for growth. Investing in multiple asset classes increases the likelihood of benefiting from the growth potential of different sectors and regions. To effectively implement these strategies, it's recommended to assess your risk tolerance, investment goals, and time horizon. Consulting with a financial advisor may be beneficial to design a suitable diversification and asset allocation plan tailored to your specific needs. Mastering Your Money, a guide to personal financial planning. Chapter 5, Retirement Planning. Retirement planning is an important aspect of personal finance. It involves preparing for life after you stop working and ensuring that you have enough financial resources to support yourself during your retirement years. Here are a few steps to help you get started. 1. Set retirement goals. Determine what kind of lifestyle you want during retirement and estimate how much you'll need to save to achieve it. Consider factors like living expenses, healthcare costs, travel plans, and any other financial goals you might have. 2. Start saving early. The earlier you start saving for retirement, the better. Take advantage of retirement accounts like 401ks, IRAs, or pensions offered by your employer. Contribute as much as you can afford, and if possible, try to max out these accounts to benefit from tax advantages and potential employer matches. 3. Create a budget. Monitor your income and expenses to ensure you have enough money available to save for retirement. Identify areas where you can cut back on unnecessary spending and allocate those savings towards your retirement fund. 4. Diversify your investments. It's important to diversify your portfolio to manage risk effectively. Consider a mix of stocks, bonds, and other investment options based on your risk tolerance and time horizon. Regularly review and reassess your investment strategy as you approach retirement. 5. Consider professional advice. If you're unsure about retirement planning or want personalized guidance, consult with a financial advisor. They can help you create a tailored retirement plan, review your investments, and provide recommendations based on your specific financial situation. 6. Continuously review and adjust. Retirement planning is an ongoing process. Regularly review your retirement plan, reassess your goals, and make adjustments as needed. Life circumstances and financial markets can change, so it's important to adapt your retirement strategy accordingly. Remember, the key to successful retirement planning is to start early, save consistently, and stay informed about your financial options. 5.1. Understanding retirement plans for 101k, IRAs, pensions. Retirement plans are essential for securing your financial future. Here's a breakdown of 3 common types. 1. 401k. This is an employer-sponsored retirement savings plan. It allows you to contribute a portion of your pre-tax income, which grows tax-free until retirement. Some employers may even match a percentage of your contributions. You can choose from various investment options within the plan, typically including stocks, bonds, and mutual funds. 2. IRA letters individual retirement accounts. These are personal retirement accounts that you can open independently. There are two main types, traditional and Roth IRAs. With a traditional IRA, contributions can be tax deductible, but withdrawals during retirement are taxed. In contrast, Roth IRA letters are funded with after-tax income, and qualifying withdrawals are tax-free. IRA letters offer a wider range of investment options compared to 401k plans. 3. Pensions. Pensions are retirement plans typically offered by certain employers, especially government entities and some large corporations. With a pension, you're eligible to receive regular payments after reaching a certain age and meeting specific service requirements. The benefit amount is often based on factors such as your salary, history, years of service, and a predetermined formula. Remember, it's crucial to take advantage of retirement plans early and contribute consistently. Consulting a financial advisor can provide personalized guidance based on your goals and circumstances. 5.2. Estimating retirement expenses and income. Estimating retirement expenses and income is an important step in planning for your retirement. Here's a general approach to help you get started. 1. Calculate your expected retirement expenses. Begin by evaluating your current expenses and consider how they may change in retirement. Some expenses, such as commuting or mortgage payments, may decrease or disappear, while others like healthcare costs or travel may increase. Make a comprehensive list of your expected expenses, including housing, healthcare, groceries, transportation, leisure activities, and any other items specific to your lifestyle. 2. Consider inflation. Keep in mind that the cost of living tends to increase over time due to inflation. When estimating retirement expenses, it's advisable to account for a reasonable inflation rate to ensure your funds are sufficient throughout your retirement years. 3. Evaluate your sources of retirement income. Take stock of your potential sources of income in retirement. These may include Social Security benefits, pension payments, withdrawals from retirement accounts such as 401k or IRAs, dividends from investments, rental income, or part-time work if you plan to continue working in some capacity. Understand the eligibility requirements, tax implications, and potential limitations of each income source. 4. Run retirement income projections. Utilize online retirement calculators, or consult a financial advisor to estimate your retirement income based on the expenses and income sources identified. These projections can give you an idea of whether your income is likely to cover your expenses and how long your savings may last. Adjust your plans accordingly if there's a shortfall or if you have excess funds. Remember, these estimates serve as a starting point, and your actual retirement expenses and income may differ. Regularly review and update your retirement plan as your circumstances change to ensure you're on track to meet your financial goals. 5.3. Calculating retirement savings needs. Calculating retirement savings needs is an important part of financial planning. To determine your retirement savings goal, you need to consider several factors. 1. Desired retirement age. Determine at what age you would like to retire. This will help you estimate the number of years you need to plan for in retirement. 2. Current age. Knowing your current age is important in determining the number of years you have left until retirement. 3. Estimated annual retirement income. Consider the lifestyle you would like to have in retirement. Calculate the annual income you will need to cover your expenses, including housing, healthcare, and discretionary spending. 4. Inflation. Take into account the impact of inflation on your retirement savings. Since the purchasing power of money decreases over time, it's important to factor in inflation when estimating your retirement savings needs. 5. Social Security and pension benefits. Determine whether you will have access to any Social Security or pension benefits upon retiring. Take these benefits into account when calculating your retirement savings goal. 6. Rate of return on investments. Consider the expected rate of return on your investments. This will help you determine how much you need to save each year to reach your retirement savings goal. By taking these factors into consideration, you can determine your retirement savings needs and create a plan to start saving accordingly. It's always a good idea to consult with a financial advisor who can provide personalized guidance based on your individual circumstances and financial goals. 5.4. Strategies to maximize retirement savings. Maximizing your retirement savings can provide you with a secure and comfortable financial future. Here are some strategies to help you achieve this goal. 1. Start early. Begin saving for retirement as soon as possible. The power of compounding allows your money to grow over time, so the earlier you start, the more time your investments have to grow. 2. Contribute to retirement accounts. Take advantage of tax-advantaged retirement accounts, such as employer-sponsored 401k plans, individual retirement accounts IRAs, or Roth IRAs. Contribute consistently and aim to maximize your contributions each year, especially if your employer offers a matching contribution. 3. Automate savings. Set up automatic contributions from your paycheck or bank account to your retirement savings accounts. This ensures that you consistently contribute without relying on willpower alone. 4. Increase contributions over time. Whenever possible, gradually increase your retirement contributions, such as contributing a percentage of any salary increase or bonus you receive. This helps grow your savings faster. 5. Take advantage of employer matches. If your employer offers a 401k matching program, contribute at least enough to receive the maximum match. It's essentially free money that can significantly boost your retirement savings. 6. Diversify investments. Diversify your retirement portfolio by investing in a mix of asset classes, such as stocks, bonds, and real estate. This helps reduce risk and increase the potential for growth. 7. Minimize fees. Pay attention to the fees associated with your retirement accounts and investments. High fees can eat into your savings over time, so choose low-cost investment options whenever possible. 8. Stay informed and adjust as needed. Keep track of your investments and periodically review your retirement plan. Adjust your asset allocation and saving strategy as necessary to align with your goals and market conditions. Remember, everyone's situation is unique, so it's essential to tailor these strategies to your individual needs. Consider consulting with a financial advisor who can provide personalized guidance based on your specific circumstances and goals. Mastering Your Money, a guide to personal financial planning. Chapter 6. Insurance and Risk Management. Insurance and risk management are essential concepts in protecting individuals and businesses from potential financial losses. Insurance is a tool that provides financial coverage in the event of unforeseen circumstances such as accidents, natural disasters, or health issues. It helps mitigate the impact of unexpected events by transferring the risk from the insured to the insurer. Risk management, on the other hand, is the process of identifying, assessing, and mitigating risks to minimize potential losses. It involves analyzing potential risks, evaluating their likelihood and impact, and implementing strategies to reduce or eliminate them. Effective risk management helps businesses and individuals make informed decisions to protect themselves against potential threats. Both insurance and risk management go hand in hand to safeguard against potential losses and provide financial security. By understanding and implementing appropriate insurance coverage and risk management strategies, individuals and businesses can protect themselves and their assets from unforeseen events. 6.1. Importance of insurance in personal financial planning. Insurance plays a crucial role in personal financial planning for several reasons. 1. Risk mitigation. Insurance helps mitigate financial risks by providing coverage against unforeseen events such as accidents, illnesses, property damage, or loss of income. By having appropriate insurance coverage, individuals can protect themselves and their families from potential financial hardships that could arise from such events. 2. Protection of assets. Insurance safeguards personal assets such as homes, vehicles, and personal belongings. In the event of damage, theft, or other covered risks, insurance can provide compensation to repair or replace these assets, avoiding significant out-of-pocket expenses. 3. Healthcare costs. Medical expenses can be significant, especially in the case of unexpected illnesses or accidents. Health insurance ensures access to quality health care without the burden of exorbitant costs. It covers medical treatments, hospitalization, prescription medications, and preventive care, helping individuals manage their health-related expenses. 4. Income replacement. Life insurance and disability insurance are crucial components of personal financial planning. Life insurance provides financial protection to beneficiaries in the event of the policyholder's death, ensuring ongoing financial support for loved ones. Disability insurance provides income replacement in case of a disability or injury that prevents an individual from earning their regular income. 5. Peace of mind. Insurance provides peace of mind by alleviating worries about financial uncertainties. Knowing that there is a safety net in place can reduce stress and allow individuals to focus on other aspects of their lives and long-term financial goals. 6. Estate planning. Life insurance can also be an integral part of estate planning. It can help cover estate taxes and debts, ensuring that loved ones are not burdened with financial liabilities after your passing. In summary, insurance is vital in personal financial planning as it protects against financial risks, safeguards assets, covers healthcare costs, provides income replacement in case of disability or death, offers peace of mind, and can assist in estate planning. It is wise to assess your insurance needs and work with a financial professional to tailor insurance coverage that aligns with your personal financial goals and circumstances. 6.2. Evaluating insurance needs. Life, health, property. When evaluating insurance needs for life, health, and property, there are several factors to consider. Here are some steps to help you determine the appropriate evaluation. 1. Assess your financial situation. Evaluate your income, expenses, assets, and liabilities to understand the level of insurance coverage you may need. This will give you an idea of how much protection is necessary to safeguard your financial stability. 2. Identify specific risks. Analyze the potential risks related to your life, health, and property. Consider factors such as your age, health conditions, dependents, property value, and location. This assessment will help you identify the types of insurance that are most relevant to your situation. 3. Research insurance options. Familiarize yourself with different insurance policies available in the market. Explore life insurance options like term life insurance, whole life insurance, or universal life insurance. For health insurance, research various plans and understand their coverage details. And for property insurance, consider policies like homeowners insurance or renter's insurance, depending on your circumstances. 4. Determine coverage amounts. Once you have an idea of the insurance policies that match your needs, determine the coverage amounts required. For life insurance, calculate the amount needed to cover outstanding debts, funeral expenses, income replacement for dependents, and any other financial obligations. For health insurance, consider factors like medical expenses, prescriptions, and potential hospitalization costs. For property insurance, assess the value of your property and the potential cost of replacing or repairing it in case of damage or loss. 5. Compare insurance quotes. Obtain quotes from multiple insurance providers to compare prices, coverage details, deductibles, and exclusions. This will help you find a balance between cost and coverage and make an informed decision. 6. Review and update periodically. As your circumstances change, it's essential to review your insurance needs regularly. Life events like marriage, the birth of a child, buying a new property, or changes in income should prompt a reassessment of your insurance coverage. Remember, insurance needs can vary from person to person, so it's crucial to customize your coverage based on your unique circumstances. If you need further assistance or have specific questions, feel free to ask. 6.3. Understanding different insurance policies. Sure, I can help you understand different insurance policies. Insurance is a way to protect yourself or your belongings from financial loss in case of unforeseen events. Here are some common types of insurance policies. 1. Health insurance. This type of insurance provides coverage for medical expenses, including doctor visits, hospitalizations, medications, and surgeries. 2. Auto insurance. Auto insurance provides protection for your vehicle against damages and liability in case of accidents. It can also cover theft and vandalism. 3. Homeowners, renters insurance. This type of insurance protects your home or rented property against damage or loss caused by events such as fire, theft, or natural disasters. It can also cover liability in case someone gets injured on your property. 4. Life insurance. Life insurance provides financial protection for your loved ones in the event of your death. It pays out a lump sum or regular income to beneficiaries. 5. Disability insurance. Disability insurance replaces a portion of your income if you become disabled and are unable to work. It can help cover living expenses and medical bills. 6. Travel insurance. Travel insurance offers coverage for unexpected events while traveling, such as trip cancellation, lost baggage, medical emergencies, or travel delays. It's important to carefully review the terms and coverage of each policy before purchasing one to ensure it meets your specific needs. Additionally, the cost and coverage can vary, so it's a good idea to compare different insurance providers and their policies. 6.4. Mitigating financial risks through appropriate coverage. Mitigating financial risks through appropriate insurance coverage is essential to protect yourself and your assets. Here are a few steps to help you choose the right coverage. 1. Assess your needs. Evaluate your specific risks and determine what assets or aspects of your life need protection. Consider factors like your health, property, income, and dependents. 2. Research and compare. Take the time to research different insurance providers, their policies, and coverage options. Compare prices, deductibles, exclusions, and the reputation of the insurance companies. 3. Understand policy coverage. Read the policy documents carefully, including the terms, conditions, and limitations. Make sure you understand what events or situations are covered, as well as what is excluded. Seek clarification from the insurance provider if needed. 4. Seek professional advice. If you're unsure about certain policies or complex insurance needs, consult with an insurance agent or broker. They can guide you through the process and help you understand the appropriate coverage for your situation. 5. Review and update regularly as your circumstances change, such as getting married, having children, or acquiring new assets. Review your insurance coverage annually or when significant life events occur. Ensure that your coverage remains adequate and up to date. 6. Bundle policies. Consider bundling multiple policies with the same insurance provider. This can potentially lead to discounts and more efficient management of your coverage. 7. Maintain adequate coverage. Avoid underinsuring yourself to save on premiums. It's crucial to have sufficient coverage to protect against financial loss. Reassess your coverage periodically to ensure it aligns with your needs. Remember, insurance is a proactive step to safeguard yourself from unexpected events. By choosing appropriate coverage, you can mitigate financial risks and have peace of mind. Mastering Your Money, a guide to personal financial planning. Chapter 7. Tax Planning and Optimization. Tax planning and optimization involve strategic measures to minimize your tax liability, while maximizing your financial benefits within the legal framework. As your personal assistant, I can provide you with a few key strategies to consider. 1. Take advantage of tax deductions and credits. Stay informed about tax deductions and credits available to you. These can include expenses related to education, healthcare, home office deductions, and energy-efficient improvements to your home. By leveraging these deductions and credits, you can reduce your taxable income. 2. Contribute to retirement accounts. Contributing to retirement accounts, such as an individual retirement account IRA or a 401k, can provide you with tax advantages. Contributions to traditional IRA letters and 401ks are often tax deductible, meaning you lower your taxable income for the year. Meanwhile, contributions to Roth IRA letters are not tax deductible initially, but qualified withdrawals are tax-free in retirement. 3. Optimize investments. Tax-efficient investing can help you minimize taxes on your investment returns. For example, holding investments for more than a year before selling them can qualify for long-term capital gains tax rates, which are often lower than short-term rates. Additionally, consider tax-advantaged investment vehicles, such as municipal bonds, which generate tax-free income. 4. Utilize tax-advantaged accounts. Explore options like health savings accounts HSA letters and flexible spending accounts FSA letters to reduce your taxable income and save on qualified medical expenses. HSA letters offer a triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. 5. Plan for charitable contributions. Charitable contributions can both support meaningful causes and provide tax benefits. By donating to qualified charitable organizations, you may be eligible for tax deductions. However, ensure you follow proper documentation and IRS guidelines. Remember, tax planning should be tailored to your individual circumstances. So, it's advisable to consult with a tax professional or financial advisor who can provide personalized advice based on your situation. 7.1. Basics of personal income tax. Personal income tax is a system implemented by governments to collect revenue from individuals based on their income. Here are some basics to help you understand personal income tax. 1. Taxable income. Personal income tax is typically based on your taxable income, which is the amount of income you earn from various sources after certain deductions and exemptions. 2. Tax rates. Governments use a progressive tax system where different income levels are taxed at different rates. As your income increases, you may move into higher tax brackets, resulting in a higher tax rate applied to the corresponding portion of your income. 3. Deductions and exemptions. Tax laws often provide certain deductions and exemptions that reduce your taxable income, thus lowering the amount of tax you owe. Common deductions include expenses related to education, healthcare, and charitable contributions. 4. Filing requirements. Individuals who earn above a certain income threshold are required to file an annual tax return. This involves reporting your income, claiming deductions, and calculating your tax liability. 5. Withholding. Many employers withhold income tax from employees' paychecks on behalf of the government. The amount withheld is based on factors such as your income level and the information provided on a Form W-4. 6. Deadlines and penalties. Personal income tax returns are typically due by a specific deadline, often in April or May. Failing to file your return or pay the taxes owed on time may result in penalties and interest charges. 7. Tax credits. Tax credits are different from deductions, as they directly reduce your tax liability rather than just lowering your taxable income. Common tax credits include those for children, education expenses, and renewable energy investments. It's important to note that personal income tax regulations can vary between countries and even within different regions or states. For accurate information and guidance, consulting with a tax professional or using government resources is recommended. 7.2. Strategies to minimize tax liability. There are several strategies that can help minimize tax liability. Here are a few commonly used methods. 1. Take advantage of tax deductions and credits. Understand the deductions and credits available to you and make sure to claim them. This may involve itemizing deductions or utilizing tax credits for specific expenses such as education or energy-efficient home improvements. 2. Contribute to retirement accounts by maximizing contributions to retirement accounts such as a 401k or IRA. You can reduce your taxable income. These contributions may also qualify for tax deductions or provide tax benefits in the future. 3. Optimize your investment portfolio. Consider investing in tax-efficient funds or tax-advantaged accounts, like a health savings account HSA or a 529 college savings plan. These accounts can provide tax advantages such as tax-free growth or tax-deductible contributions. 4. Manage capital gains and losses. Be strategic about buying and selling investments to help minimize capital gains taxes. By offsetting capital gains with capital losses, you may be able to reduce your overall taxable income. 5. Consider your business structure. If you have a business, choosing the right business structure can have significant tax implications. Consult with a tax professional to determine whether a sole proprietorship, partnership, corporation, or other structure is most beneficial for your situation. 6. Plan charitable giving. Donating to qualified charitable organizations can result in tax deductions. Keep track of your charitable contributions throughout the year and ensure you meet the necessary criteria for claiming deductions. Remember, each situation is unique, and it is always advisable to consult with a tax professional who can provide personalized advice based on your specific circumstances. 7.3. Tax-efficient investing. Tax-efficient investing refers to strategies and approaches that aim to minimize the tax burden associated with investment activities. Here are a few key strategies to consider. 1. Tax-advantaged accounts. Utilize tax-advantaged accounts such as IRAs, 401ks, or Roth IRAs to benefit from tax advantages such as tax-free growth or tax deductions. 2. Asset location. Allocate investments strategically across taxable and tax-advantaged accounts. Generally, it is advisable to hold tax-efficient investments like index funds or ETFs in taxable accounts, while placing less tax-efficient assets such as actively managed funds or bonds in tax-advantaged accounts. 3. Tax loss harvesting. Take advantage of tax loss harvesting by selling investments that have experienced losses to offset capital gains. This can help reduce your overall taxable income in a given year. 4. Dividend considerations. Be mindful of the tax impact of dividends. If you are investing in taxable accounts, prefer investments with qualified dividends, which are taxed at lower rates than non-qualified dividends. 5. Long-term capital gains. If possible, hold investments for longer than 1 year to qualify for long-term capital gains tax rates, which are generally lower than short-term rates. 6. Tax-efficient investment vehicles. Consider utilizing tax-efficient investment vehicles, like index funds or ETFs that have lower turnover, resulting in reduced capital gains distributions. Remember that tax laws can be complex and subject to change, so it's always a good idea to consult with a qualified tax advisor or financial professional to tailor investment strategies to your specific tax situation. 7.4. Understanding tax deductions and credits. Tax deductions and credits are valuable tools that can help reduce your overall tax liability. While they both serve the purpose of lowering your tax bill, they differ in how they achieve this. 1. Tax deductions. Tax deductions reduce your taxable income. which in turn lowers the amount of income subject to tax. Deductions are typically subtracted from your total income before determining your tax liability. Some common tax deductions include standard deduction, a set amount that varies based on your filing status. It is a deduction available to all taxpayers, and you can choose to claim the standard deduction or itemize your deductions. Itemized deductions. These are deductions for specific expenses that you can claim instead of the standard deduction. Examples of itemized deductions include mortgage interest, state and local taxes, medical expenses exceeding a certain threshold, and charitable contributions. Above-the-line deductions. Certain deductions are deducted from your total income, even if you do not itemize. These deductions can reduce your adjusted gross income (AGI), and include items like student loan interest, educator expenses, or health savings account contributions. 2. Tax credits. Tax credits directly reduce your tax liability on a dollar-for-dollar basis. Unlike deductions, which reduce taxable income, credits are applied directly to the amount you owe in taxes. Some common tax credits include child tax credit, a credit provided to eligible taxpayers for each qualifying child, which has the potential to reduce your tax liability significantly. Earned income tax credit, a credit designed to help low to moderate income individuals and families. It provides tax relief based on income and the number of qualifying dependents. Education credits, credits such as the American Opportunity Credit and the Lifetime Learning Credit, are available for qualifying education expenses incurred by you, your spouse, or your dependents. Renewable energy credits. Credits are available for individuals who make energy-efficient home improvements or install renewable energy systems. It's essential to research and consult with a tax professional to understand which deductions and credits you qualify for, as eligibility can vary based on your personal circumstances and the current tax laws. Mastering Your Money, a guide to personal financial planning. Chapter 8, Estate Planning and Legacy Building. Estate planning and legacy building are essential aspects of ensuring that your assets are protected and distributed according to your wishes after you pass away. As your personal assistant, I can provide you with some valuable information and guidance on this topic. To start with, estate planning involves creating legal documents that outline how your assets, such as property, investments, and personal belongings, will be managed and distributed. Some key components of estate planning include creating a will, establishing trusts, designating beneficiaries, and appointing an executor to carry out your wishes. Legacy building goes beyond just the financial aspect, focusing on preserving and passing on your values, experiences, and memories to future generations. It involves identifying your core values, documenting your life story, and considering philanthropic endeavors or charitable giving that reflect your passions and interests. Here are a few steps to consider when it comes to estate planning and legacy building. 1. Take stock of your assets and liabilities. Make a comprehensive list of your assets, including bank accounts, investments, real estate, and personal belongings. It's also important to consider any debts or liabilities you may have. 2. Write a will. A will is a legal document that specifies how you want your assets distributed after your death. It's essential to consult with a qualified attorney to ensure your will is legally valid and clearly expresses your intentions. 3. Consider trusts. Trusts can be useful tools for estate planning, allowing you to control the distribution of your assets and potentially minimize estate taxes. Different types of trusts serve different purposes, so it's advisable to consult with a professional to determine the most suitable options for your situation. 4. Establish beneficiaries. Designating beneficiaries for your retirement accounts, life insurance policies, and investment accounts is essential. Updating these designations regularly is also crucial if your circumstances change. 5. Appoint an executor. Selecting a trustworthy person to act as the executor of your estate is important. This individual will be responsible for ensuring your wishes are fulfilled and handling the administrative tasks associated with settling your estate. 6. Preserve your legacy. Consider capturing and preserving your life story, values, and experiences for future generations. This can be done through written records, photographs, videos, or even audio recordings. You may also explore opportunities for philanthropic activities or contributions to causes you care about. Remember, estate planning and legacy building are complex processes that require careful consideration and professional advice. It's highly recommended to consult with an attorney or estate planning professional to help you navigate through the legalities and ensure your wishes are properly documented and implemented. 8.1. Importance of planning for the future and the next generation. Planning for the future and considering the needs of the next generation is crucial for several reasons. 1. Sustainability. By planning for the future, we ensure that our actions today do not deplete resources or harm the environment to such an extent that it becomes difficult for future generations to thrive. This includes taking measures to combat climate change, preserving natural resources, and adopting sustainable practices. 2. Economic stability. Planning for the future helps ensure economic stability by anticipating and addressing potential challenges and opportunities. It involves developing long-term strategies for industry, infrastructures, and investments that can support sustainable economic growth for future generations. 3. Social progress. Planning for the future involves addressing social challenges and promoting progress. This includes ensuring access to quality education, healthcare, and social support systems, as well as fostering equitable opportunities for all individuals. By planning for these aspects, we can create a better society for future generations. 4. Intergenerational equity. Planning for the future ensures fairness and justice between generations. It involves considering the needs and aspiration of the next generation, and taking steps to ensure they inherit a world that is better, or at least as good as the one we have today. This may involve making thoughtful policy decisions, such as reducing inequality and providing equal opportunities. 5. Preparedness for uncertainties. Planning for the future allows us to be prepared for potential uncertainties and challenges that may arise. By anticipating and planning for contingencies, we can minimize negative impacts and ensure a smoother transition for future generations, be it in the face of social, economic, or environmental changes. In summary, planning for the future and the next generation is vital for sustainability, economic stability, social progress, intergenerational equity, and preparedness. It helps us create a world that is better equipped to meet the challenges and provide opportunities for future generations to thrive. 8.2. Strategies for estate planning. Sure, here are some strategies for effective estate planning. 1. Create a comprehensive will. A will allows you to outline your wishes for the distribution of your assets. Designate guardians for minor children, and name an executor to manage the process. 2. Establish trusts. Trusts offer benefits such as minimizing estate taxes, avoiding probate, and providing for the ongoing management of assets. You can create revocable or irrevocable trusts based on your specific needs. 3. Consider beneficiary designations. Review and update beneficiary designations on financial accounts, insurance policies, and retirement plans to ensure they align with your estate planning goals. 4. Plan for incapacity. Set up powers of attorney for financial and healthcare decisions, as well as a living will or healthcare directive to specify your preferences for medical care if you become unable to communicate. 5. Minimize estate taxes. Explore strategies like gifting assets during your lifetime, establishing charitable trusts, or utilizing exemptions and deductions to minimize the impact of estate taxes. 6. Plan for business succession. If you own a business, Develop a plan for its smooth transition to your chosen successor or heirs. This may involve creating a buy-sell agreement, establishing a trust, or making other arrangements. 7. Review and update regularly. Regularly review and update your estate plan to reflect changes in your financial situation, family structure, or personal goals. This ensures that your plan remains current and effective. Remember, estate planning can be complex, so it's advisable to consult with a qualified estate planning attorney or financial advisor who can guide you through the process based on your specific circumstances and objectives. 8.3. Creating wills and trusts. Certainly, creating wills and trusts is an important aspect of estate planning. To get started, you may consider following these steps. 1. Determine your assets and beneficiaries. Make a list of all your assets, including property, investments, and personal belongings. Next, decide who you want to designate as beneficiaries to receive these assets. 2. Choose an executor or trustee. An executor will handle the distribution of your assets after your passing, while a trustee manages any trust you create. Select someone you trust and who is willing to fulfill these responsibilities. 3. Consult an attorney. It's advisable to consult an experienced attorney specializing in estate planning and probate laws. They can guide you through the legal process and ensure your documents are valid and compliant with the local regulations. 4. Draft your will. Work with your attorney to draft a will that clearly outlines your wishes regarding the distribution of assets, appointment of guardians for minor children, and any specific instructions you have. 5. Consider creating trusts. Depending on your situation, you might also want to establish trusts. Trusts can provide flexibility, tax benefits, and added control over the distribution of assets. 6. Review and update regularly. It's essential to review and update your will and trust documents periodically, especially after major life events like marriages, divorces, births, or significant changes in your assets. Remember, while this advice provides general information, it's always best to consult with an attorney to ensure your wills and trusts meet your specific circumstances and adhere to local laws. 8.4. Charitable giving and philanthropy. Charitable giving and philanthropy are wonderful ways to make a positive impact and contribute to causes you care about. Here are some steps to consider when engaging in charitable giving and philanthropy centers. 1. Identify your values and passions. Start by reflecting on the issues or causes that resonate with you. Determine the areas where you want to make a difference and align your charitable giving with your values. 2. Research and vet charitable organizations. Take the time to research different charitable organizations to ensure they are reputable, transparent, and effectively use the donations they receive. Websites, financial reports, and testimonials can provide valuable insights into their work. 3. Set a budget and donation strategy. Determine how much you can comfortably allocate towards charitable giving and create a budget. Consider setting aside a specific percentage of your income or a fixed amount each year. Additionally, you may choose to donate regularly or make one-time contributions based on your preferences. 4. Explore different types of giving. There are various ways to contribute, including direct donations, recurring donations, fundraising campaigns, volunteering time or skills, or donating assets like stocks or property. Assess which options align with your goals and explore their benefits and tax implications. 5. Engage with the charities you support. Beyond financial contributions, consider getting involved with the charities you support. Attend events, volunteer your time, or utilize your skills to contribute to their missions. This hands-on approach can deepen your connection with the organization and have a more meaningful impact. 6. Maximize your impact. Research matching gift programs offered by employers, or consider collaborating with others through collective giving initiatives. Additionally, Explore opportunities to leverage your donations through strategic philanthropy, such as targeted grants or investments in social enterprises. Remember to consult with financial advisors or tax professionals to understand the tax implications of your charitable giving, especially if you plan to donate significant amounts or have complex financial situations. Financial education for a lifetime. Financial education is crucial for everyone to achieve financial stability and make informed decisions throughout their life. Here are some key areas to focus on for a lifetime of financial education. 1. Budgeting. Learn how to create and stick to a budget. This involves tracking income, expenses, and savings goals to gain control over your finances. 2. Saving and investing. Understand the importance of saving money for short-term goals and building a solid emergency fund. Additionally, learn about different investment options, such as stocks, bonds, and mutual funds, to grow your wealth over time. 3. Debt management. Educate yourself about managing debt responsibly. This includes understanding interest rates, paying off high-interest debts first, and avoiding unnecessary credit card debt. 4. Tax planning. Gain knowledge about tax laws and obligations. Learn how to optimize tax benefits, such as deductions and tax-advantaged accounts, to minimize your tax burden. 5. Insurance coverage. Understand the importance of different types of insurance, such as health, life, disability, and property insurance. Determine the coverage you need based on your individual circumstances. 6. Retirement planning. Start early and save consistently for retirement. Learn about various retirement accounts, like 401ks and IRAs, and explore the concept of compound interest. 7. Real estate and home ownership. Familiarize yourself with the housing market and the pros and cons of renting versus buying. Learn about mortgages, property taxes, and maintenance costs associated with home ownership. 8. Financial risks and diversification. Understand the risks involved in investing and how to diversify your portfolio to reduce risk. Learn about asset allocation and the importance of a balanced investment strategy. 9. Financial literacy. Continuously educate yourself about personal finance topics by reading books, following reputable financial websites and blogs, and attending seminars or webinars. Stay up to date with changing financial trends and regulations. 10. Estate planning. Plan for the future by creating an estate plan. This involves drafting a will, designating beneficiaries, and considering the impact of taxes on your estate. Remember, financial education is an ongoing process. Stay curious, seek knowledge, and make informed decisions to build a strong financial foundation for a lifetime. 9.1. Teaching financial literacy to children and teenagers. Teaching financial literacy to children and teenagers is crucial for their future financial well-being. Here are some tips on how to approach it. 1. Start early. Introduce basic financial concepts from a young age. Teach them about money, saving, and the importance of budgeting. 2. Make it practical. Incorporate real-life examples and hands-on activities to make financial literate, while engaging and relatable. For instance, encourage them to save for a specific item they want, or involve them in creating a household budget. 3. Teach budgeting. Show them how to create a budget by allocating money for different expenses, such as savings, spending, and giving. Help them understand the importance of prioritizing needs over wants. 4. Introduce bank accounts. Teach the importance of having a bank account and how it works. Explain the concept of earning interest and the benefits of saving money in a secure place. 5. Explore earning opportunities. Encourage teenagers to take on part-time jobs or small business ventures. This teaches them about income, expenses, and the value of hard work. 6. Discuss credit and debt. Explain the concept of credit cards, loans, and interest rates. Teach them the potential consequences of overspending and the importance of responsible borrowing. 7. Teach about investments. Introduce the concept of investing and how it can help grow money over time. Explain basic investment options like stocks, bonds, and mutual funds. 8. Role model good financial habits. Children and teenagers learn a lot by observing their parents or guardians. Set a good example by demonstrating responsible money management, saving, and avoiding unnecessary debt. Remember, financial literacy is an ongoing process. Continuously provide opportunities for learning, answer their questions, and help them navigate financial decisions as they grow older. 9.2. Navigating major life events, marriage, parenthood, etc. Navigating major life events like marriage and parenthood can be both exciting and overwhelming. As your personal assistant, I'm here to provide guidance and support. Here are a few tips to help you through these significant lessons. 1. Communication is key. Clear and open communication with your partner or family members is essential. Discuss your expectations, values, and goals to ensure everyone is on the same page. 2. Seek advice and learn from others. Reach out to friends, family, or even professionals who have experienced similar life events. Their insights and experiences can offer valuable guidance and help you make informed decisions. 3. Plan ahead. Major life events often require careful planning. Create a checklist of tasks, timelines, budgets, and any necessary legal or administrative steps. This will help you stay organized and reduce stress. 4. Take care of yourself. Remember to prioritize self-care. Major life events can be emotionally and physically demanding, so make sure to prioritize your well-being throughout the process. Take breaks, seek support from loved ones, and address any stress or anxiety you may be feeling. 5. Embrace flexibility. Life events rarely go exactly as planned. Embrace the unexpected and be open to adapting your plans as needed. Being flexible and maintaining a positive mindset will help you navigate any challenges that come your way. Remember, I'm here to assist you throughout these major life events. Feel free to ask for more specific advice or guidance based on your unique circumstances. 9.3. Adapting financial plans over time. Adapting financial plans over time is crucial to stay on track and meet your financial goals. Here are some tips to help you adjust your financial plans as your circumstance change. 1. Regularly review your financial goals. Take time to assess and evaluate your financial goals. Are they still relevant? Have your priorities shifted? By periodically reviewing your goals, you can make necessary adjustments to ensure they align with your current situation and aspiration. 2. Track your expenses. Keep a close eye on your spending habits. Regularly review your expenses to identify areas where you can cut back or make adjustments. This will help you free up funds to allocate towards other financial goals or unexpected expenses. 3. Modify your budget. As your financial situation evolves, adjusting your budget is essential. Consider reallocating funds based on your changing needs and goals. Add new categories or remove unnecessary ones. Ensure that your budget reflects your current income, expenses, and financial objectives. 4. Revisit your saving and investing strategies. As your financial goals change, you may need to reassess your saving and investing plans. Explore different saving methods to achieve your desired milestones. Update your investment portfolio to align with your risk tolerance and time horizon. Regularly review and rebalance your investments as needed. 5. Reevaluate your insurance coverage. Major life events may warrant modifications to your insurance coverage. Whether it's adjusting your life insurance, adding disability insurance, or reevaluating your health insurance, make sure your coverage adequately protects you and your loved ones in your current situation. 6. Seek professional advice when needed. Consider consulting with a financial advisor or planner to help you navigate complex financial matters. They can provide personalized guidance and help you create a plan tailored to your specific needs and goals. Remember, Adapting your financial plans is a dynamic and ongoing process. Regularly assess your financial situation, stay informed about market trends and opportunities, and make adjustments as needed to ensure you stay on track toward financial success. 9.4. Staying informed about evolving financial trends. To stay informed about evolving financial trends, here are a few suggestions. 1. Read financial news. Subscribe to reputable financial news outlets or websites. Stay updated on the latest trends, market news, and analysis provided by trusted sources. 2. Follow financial experts and influencers. Follow influential figures in the finance industry on social media platforms like Twitter, LinkedIn, or YouTube. They often share valuable insights, market analysis, and trends to keep you informed. 3. Join financial forums or communities. Participate in online forums or communities focused on finance and investing. Engage in discussions with fellow members to exchange ideas, ask questions, and learn from their experiences. 4. Attend webinars and conferences. Look for webinars or virtual conferences conducted by finance professionals or industry leaders. These events provide insights into emerging trends, investment strategies, and analysis that can help you stay informed. 5. Utilize financial apps and tools. Explore financial apps and tools that provide real-time market data, personalized news feeds, and analysis. These resources can help you track trends, analyze investment options, and manage your finances effectively. 6. Engage with financial podcasts and videos. Listen to finance-focused podcasts, or watch videos that discuss market trends, investment strategies, and financial news. This can be a convenient way to stay informed while on the go. Remember, always conduct your own research and exercise critical thinking to evaluate the accuracy and reliability of the information you come across. Financial trends can change rapidly, so it's important to stay vigilant and adapt your strategies accordingly. Conclusion: Mastering Your Money, a guide to personal financial planning, equips readers with the essential knowledge and skills to take control of their financial destiny. By implementing the strategies outlined in this book, you will be empowered to make informed financial decisions, achieve your goals, and secure a prosperous future for yourself and your loved ones. Financial independence is within your reach. It's time to embark on your journey toward mastering your money.